Good morning and welcome to the Morning Bell for December 19th, 2025. I am Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. So please keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. Good morning, Fred. Good morning, Martin, Simon, everybody else here. I appreciate you being here on a cold winter day here in the Midwest. Coming back to some winter behavior again after a little reprieve yesterday with a lot of rain. In any case, how's the market? The market is okay. We're going into the holidays. Seems like a slowdown period. Yesterday looked like maybe we could get a more extended rally. It's up a little bit today in terms of tech, but the S&P flat today, a little pullback from the highs yesterday. Broadly, just looking at some maybe consolidation before the end of the year, maybe a drift higher. Today we have a big expiration. So a lot of open positions in December generally. And this year is a record-breaking number of open positions, notional values, etc. So there's a lot of potential for some volatility today. And while it may not mean anything from a fundamental standpoint, it may cause some weird chop near the close as we start to maneuver around large open interest strikes. I think a prime example is one that we've been watching, NEM. There's the big open interest at $100 a share. Stuff like that can mean we get some interesting market behavior based upon open interest. So I kind of take it for what it's worth. I think we understand that those technicals can have an impact on the future. But open interest may actually be a big driver of market behavior today that then sets up new technical formations in the weeks ahead. All right, so what's the market doing today? I got a feeling that the market's going to be doing a lot of fighting, kind of maneuvering around strikes, maneuvering around bull-bear battle. Traditionally, I would say today just would normally be a bit of a slow day had it not been an expiration, had we not had the big open interest, but we may have a lot of volume today as people, reposition from December options that are expiring into other terms, whether it's December of 26, January of 26, or something else. So we'll have to keep an eye on that and see how people decide to manage their positions and if that has a real impact on the market. Otherwise, more of the status quo of, I think, generally looking for put credit spreads, occasionally looking for the call position. And if things start to fall out of bed, looking at puts via a hedge using some of the ETFs. Probability of success is again driven by those put credit spreads. VIX is falling, return on capital is getting very low. So even with put credit spreads, it can be hard to find enough premium to justify a trade. So the put credit spreads would normally be the main target, but the opportunities are getting fewer and further in between until we get into a trend with the VIX this low. So just, again, keeping that in mind with the VIX this low, there is still an opportunity to trade the range, but sometimes now, instead of trading the range by selling a put credit spread and saying I've got really good support here, I have to look at what the bounce back trade is. Sort of the idea of like triple M, where I'm looking for the bounce back now because I don't get enough money back from a put credit spread. And if support holds, I expect to bounce back to at least mid-range, if not the highs of the range. So I can trade the range, or I can sit on the sidelines in triple M. I don't see a good opportunity to sell a put credit spread because I take a lot of potential for heat and have a low expected value because of that low return on capital. So I'm looking at some opportunities with a lower probability of success, but a higher return on capital as a way to trade those support levels now instead of just selling put credit spreads, which would be sort of a more normal process. And at the end of the day, that means that maybe fewer market positions right now and staying a little bit cash heavier until we get better opportunities. Having the opportunity to get into better trades later is better than forcing a trade today. Allowing more time can work with the VIX low. Going into January and February options, knowing that I'm paying a earnings premium if I get into February in particular. January, I'm paying an earnings premium in general for like financials because they're some of the earliest to report on the earnings cycle. If I get into February, I'm going to be dealing with some earnings premium. So again, kind of keeping that in mind. Still don't want to sell naked options and still looking at end of day to make trades. But today, I don't think necessarily a day that I'm looking to do a lot. Friday before a holiday week with Christmas next week and the market closed on Thursday, half day on Wednesday. I don't feel the need to take a weekend risk. I expect that, Wednesday and Thursday and Friday are going to be pretty slow next week. Maybe there's a put credit spread with low premium on Monday, but no need to take the weekend risk overall for the put credit spread unless the opportunity is very clear. Particularly given that we may get some volatility today. Excuse me. Let's see. Still going to be aware of earnings dates. Not going to be much during next week. Not going to be much until we get into the next main cycle, a couple weeks into January. But nonetheless, there are still a few here and there. Today the market may kind of be chasing its own tail around that open interest, so just kind of be aware of that when dealing with execution and things of that nature. All right. Outside of that, just maintaining flexibility, and sometimes that flexibility means cash. All right, first things first, 10-year yield going nowhere still. We got down to 4.1, we bounced back to 4.15. Maybe we go back down to 4, maybe we go back up to 4.2, but we're stuck at 4.1. So there's nothing shifting here. We check it nonetheless. CPI data yesterday was low. People are questioning whether it was accurate. And so it becomes a less meaningful input now until the next CPI data. So, if we're not going to trust the numbers, then they're not going to have as much impact. So if they come in low, like we did with CPI, and people say, well, it's just wrong because it should be higher. And when it comes in high, people say, well, it's wrong, it should be lower. Then we're just discounting the impact because we're discounting the numbers that come out. So again, kind of keeping that in mind. With regards to MMFI, 55%, still very neutral, very market neutral positioning. We'll see if that starts to shift up. We're seeing a little bit of a rally in tech today. Some of those tech names got below the 50-day moving average, or a lot of them got below the 50-day moving average during the pullback in November and the pullback over the last week. And so if those start to bounce back above, that can help MMFI and also give some general bullish tone to the market if growth stocks are starting to get some allocation again into the end of the year and positioning for 2026 investment themes. And on the note of risk on, we're getting a little bit of a bounce back again in crypto. Bitcoin testing the lows and bouncing off of that support. Minor resistance at 90, bigger resistance at 94. We get through that, and we're looking for another 10%-ish going towards 104. So, we're in a choppy, tight range near the lows with support holding well. Still think trading the range kind of makes some sense here. As we get a little bit more time past, January no longer becomes the spot to be. So starting to think about moving the range trading into February, probably, the last week of the year after Christmas, moving into February. January can still work for now. There's still enough time with a full month, but or 4 weeks, but it's not great when we get to the final 2 weeks unless the market's dynamically moving. All right. So with that, we got the S&P 500. Yesterday, bounced back, held above the 50-day moving average, pulled back a little bit intraday, down about a point today, so less than a 0.25% for now. Big open interest around that 6,800 strike in S&Ps. It's like 682 or something like that. For SPY, a couple bucks above here. Kind of helps set our range. 675, 680 are going to be big open interest levels, right? 6750, 6800. They're big numbers we may get some battle between them. We may get some chop between them. For those looking at day trading opportunities, we may see some chop back and forth that could create an opportunity. We may just sit at a strike and stop. So if we go the latter route, we should get some indications of that in the first hour or two of the day. If there's not a lot of movement, we get to a strike and then just kind of stall out. Then I expect that means that we're setting kind of the range until the last hour of the day when people start to clean up expiring positions, hour or two. And then particularly interesting could be the last 15 minutes. God, I don't remember which expiration it was, but there was an expiration a few months ago where like Microsoft moved, like $6 in the last 5 minutes of the trading day as we went from one strike to the through a couple of big open interest strikes as people started, kind of playing around with that and defending their levels and stuff like that. So, we may see that near the close. We may see it throughout the day. We may just see nothing today. It's kind of a mixed bag of what to expect. But I think all options are on the table, which means today may be a little bit of an unpredictable day. When it comes to the VIX, and we're going to get a stall in the data here in the last minute before the market open. We'll come back to that in a moment. Let's see. I'll just run through this real quick, just to illustrate the lack of earnings coming up next week, just to remind you guys while I've got a minute. Monday, nothing. Tuesday morning, nothing. Tuesday afternoon, nothing interesting. Wednesday, no surprise, nothing. Christmas Eve. Thursday, nothing. Friday, nothing. So just a reminder that next week is nothing on earnings. When we get to the next week, the final week of the year, nothing. So earnings start to kick up again. Let's see. There we go. We finally get one on January 6th, January 7th. Still nothing interesting. The first interesting stuff starts to kick up January 7th. We've got Constellation Brands. And then we start to get into some financials as we get into the following week. So you could just see this kind of lack of earnings information coming up. We got non-farm payrolls. And then the financials start coming in January 13th, January 14th, Bank of America, Wells Fargo, Citigroup. So we've got a lack of information coming out on individual companies for a little bit here. Before I go to the VIX, the model shows SPY potentially lower over the next 10 days. I did see that as well, and I was a little bit surprised by that, to be honest. That'll shift over the weekend. So today's behavior will either be confirmation of that or necessity of a shift. I think the weakness from open to close yesterday had an impact on the model. If today ends up down like it was looking pre-market, perhaps a bit more concerning. If we end up, say today closing around 678 or 679, I think the model will shift back into bounce, sort of this look, the one we've got for triple M, more range bounded trading. So I do expect to see the model shifting if we have a 678, 679 type close, around where we're at right now. All right. So that's where like the open interest can have a big impact on the model, because we may have a weird day with big volume. Big volume means generally we consider that like a more meaningful day, I believe, in the model. So if we have a big volume up day, even though it's more driven by open interest, it can have an impact on the way things are projected out. If we have a big volume down day to 673, like right in line with where we were expecting the close in SPY. Reminder, we're expecting the close to be 675, low of 673. But if we see a model or a close, near the lows of this range, then this becomes more of a potential reality. We do have a $2 dividend today. That was my SPY was down this morning because of a $2 dividend. Sorry, the now being up $1.45 means we're up $3.45. So it's a real decent bounce today now after all. But we'll watch that throughout the day. And VIX below 16 would normally go in line with a rallying market. So it's a little mixed bag of signals, right? So the model says down, VIX says up. Market right now says up. We could see below 15 next week. We could probably get down to 15.5 today if we have a generally bullish day with a little bit of quiet to it. You know, we go to 6,800 and then just stall all day. Wouldn't be surprised to see the VIX just get annihilated today, as there's less likely to be a lot of buyers of options today. More often than not, that open interest is driven by people selling premium. So if they start to roll that premium, they're going to be buying back their December cheap options expiring today and then selling stuff out in later terms, which brings down implied volatility as well. So again, keeping that in mind, just market dynamic stuff. If there's hedgers, they'll start to buy puts. So we'll see skew come up a little bit. It already came up a little bit, so maybe people have already rolled some of their put hedges, but there's still a lot of open interest out there to maneuver around, and we may get, again, some funky moves in skew and VIX and things like that in the market as a result. With regards to the other stuff, we've got small caps up about 0.2% today. Inside day right now. We're not below yesterday's low. We're not above yesterday's high, but a good start of buying today. You know, we start getting above 252 and, you know, the technicals start looking for that retest of highs. So up $2 and the predictions, I think, become more for the next $5 to be to the upside. We start to fade, and then there's that concern that where's the next support level, probably around, you know, 240, 237.5. Right now, we're just consolidating and coiling the spring. Within small caps, there's been a focus on healthcare that's been very uncorrelated to the market. Consolidating here, had some really good money flow in November, December, not anything special. XLF kind of coming back to being my main focus within IWM. Financials being strong is a good thing for IWM, and also broadly a good thing for economic forecasts and the broad market. So seeing financials start to set up maybe a bull flag here, a good sign. We're not a higher high. We are at an inside day right now. Maybe next week we start to look at a technical bull flag, minor resistance near at the highs that were made last week, or sorry, on Monday. But generally speaking, we didn't get much of a pullback here, and financials look generally good. And XLE, another one that's been weak recently due to oil prices. And you can see here oil bouncing off the lows. Did attempt to break down. So far, looks like another rejected breakdown. So we'll see if, again, that bounces back to the 200-day moving average around 72. But right now, you know, all signs are kind of pointing to USO being another one of those breakdowns, false breakdown, bounce back. If we get a breakout, most likely to be another false breakout, very range bound, and maybe a sector to just, again, trade ranges. When we go to tech, what did I press? There we go. Tech up about 0.75% today and above yesterday's high and above Wednesday's high of 613.65, very slightly above it. Have traded a little bit of small volume above it. Being above that high is a good thing for tech, showing that people have maybe stopped selling their tech before the end of the year. This was maybe the last needed selling pressure that came in on Wednesday. All right, so we had the non-farm payrolls number. Then we got CPI, and now market seems to be ready to bounce back and find some resistance at 630 and further resistance at 637. So again, very range bound, but you know, the put credit spreads just aren't great. So like when I look at an NVIDIA, maybe I look at a 170 put credit spread, you know, so for next week, that would be 170, 167.5. It's 30 cents. It's not worth it in NVIDIA. I have to add a week just to get to a premium that I'm almost comfortable selling, 46 cents. I like 50 cents. So this is, you know, kind of back to that thought of, well, the premium may be too low for me to sell, If I want to play for the bounce back, I'm looking for 187.5, and I go out to January and I look at the 180 calls, and I can make a little bit of money in that scenario, and that may be the best it gets to. Is so paying $6 to sell it out around 8. It's not a lot of payoff, right? So if it's not a lot of payoff, maybe it goes to 9, maybe it gets to 10. Like my max payoff is probably around 50% return. My worst loss is 100%. I got to have high probability of the bounce back to the highs to make it worthwhile, and I just don't see that being generally quite enough in a stock like Nvidia at this time. Now, if my play is thinking that we can go to 195 or 200, different story. My personal view is that 187.5, 186, something in this range would be my bounce back play, and I just don't want to play for that. And so if the implied volatility is too low to sell a put credit spread, but the market's not really giving me leverage for the bounce, it's because it's range bound and the market accepts that and probably priced right to restrict trading opportunity. SMH is up 2.25% today, which is a very good sign for the tech market. Again, above the Wednesday high. Are we above the Tuesday high now? Yes, we are above the Tuesday high. So semiconductors are showing a bull indicator. We're seeing some risk on between semiconductors, Bitcoin, stocks like Nvidia, Palantir. So there may be a drive towards tech here. As Palantir tests this resistance, they can get above, 200 maybe in the cards here in the next week and Christmas week. Lack of sellers next week maybe allows it to drift up. Again, put credit spreads, not really going to cut it. Like a 177.5, 175, or even a 180, 177.5 doesn't pay me. January 190 calls don't really pay me for a bounce to 200. So, still more of this, Palantir and Nvidia and things like that are interesting in that they may rally. But I'd probably rather just do a stock trade and say, okay, well, if Palantir fades below 180, I'm out. And I think you can go to 200, and that's where I'm out on the profit side, and I'm risking 8.5 to make 11.5. Let's look at MU since we're on the tech side. Testing the breakout. Implied volatility should come down a bit more here towards 50 or lower. So there is a little bit of downside to volatility, but we're at the breakout spot where I would normally prefer a buying of a call. 245 put maybe, use yesterday's low. So I like to put credit spreads close to 50 cents, a cash secured put of selling a 245 or a 240 put and just saying, okay, well, if we get below 240, I'm willing to buy the stock. Looks like the implied volatility is falling. So, this updates implied volatility based upon mid-market levels as we start to fall, as we start to update. So we may see that get back down to unchanged on the day. Yeah, I think there could be a justification for a 245, 242.5 put credit spread if you want to define the risk, or selling a put slightly lower just because you've got that liquidity risk if we start to fall. The gap fill back to the pre-earnings high is 237.5. So it looks like pretty low risk. It's going to use up a bunch of capital from many people. You sell one put and I'm locking up 26 grand. So, just keeping that side of things in mind. Overall, I don't see a major problem with it. If wanting to go a little bit more aggressive, because the implied volatility is still high, while I'd normally prefer an uncapped, just outright call, I'd look for the call vertical, 260 to 290 or 270, 300. That's going to give me some leverage to the upside. And now that's the way to play for the continuation breakout here without exposing too much risk, I suppose. I mean, I do generally prefer the buying of the dip, but the market is starting to take away that opportunity as we start to show some more signs of bullishness today. Now, tech up almost 1%, semiconductors up 2.5%. We're seeing some bullish behavior today. let's see. Oh, how do I read the full? So for rebound in early next year, that would be like, the dogs trading, and like one of the first ones that comes to mind for me would be Netflix, right? So people sold a lot of Netflix here. You got a lot of tax loss selling. If you like Netflix, I would say that that's a reasonable potential trade for like that rotation into end of year recovery, where you get this theory of the Dows of the dog, or the dogs of the Dow. You buy the weakest performing Dow stocks, you sell the best performing Dow stocks at the end of the year or at the very beginning of the new year. Certainly, I would expect to have seen some tax loss selling here in Netflix this year. Over the course of the year, it is up slightly, but for most of the year, it was trading above current levels. Ever since the April lows, it's been above that. So there should have been some selling there that may shift out into to next year. So I mean, within that tech space, with semiconductors and tech generally looking strong. Oops, MSFT, not MFST. Let's see if this is, nah, it's not down enough to say tax loss selling. Adobe, maybe same kind of idea, just had strong earnings, starting a recovery here. It's down a chunk on the year. Nah, not enough downside. It didn't spend enough time up high. If the crypto market does want to run back up, people that have been long these type of stocks, like the marathons and the riots, Marathon in particular, because it's at the yearly lows. Heck, what else has been kind of weak like that? Target down, yeah. Target might be low enough. We started to see some buying of Target. The sellers may have finally run out there. I'm just looking for stocks that are generally down on the year, maybe starting to consolidate. I think Netflix looks like one of the best for that, from that side of things, only because it's starting to consolidate here near the lows, hasn't really bounced, but it is one that's got some of the greatest question mark to it, because frankly, people don't like Netflix right now. We start to see prices back above 98, 99, maybe even above 100, and I get a little bit more excited. We started to see some of that bounce in Target already. So Target may be a little bit sooner, but if I'm looking into the tech space, Netflix would be one that I would be bringing to mind first, just between the Mag 7 type thought process as well as just general tech buying. All right. Let me see if on this scanner I can do something with price. Yeah, let's just see what that does. No. Here we go. This is what I want. Ascending. And then I'll add in a filter for underlying volume. Say 2 million shares. Yeah, let's go more. Let's go like 10 million. Just to kind of get some ideas of stocks that are near the lows here that trade a lot. Here, let's. All right, then we can see it here. And then look for some names that are somewhat familiar, like there's MSTR, of course. PayPal. There could be another one of interest. You know I hate Pinterest. So let's look at like PayPal. You know, kind of sitting near lows here, near the 52-week lows. Probably not much bounce here. There was some tax loss selling. MSTR certainly, you know, I said in Marathon, but honestly, MSTR probably one of the better ones then from that perspective. A lot of losses for those that have been long MSTR, and if we start to get bullish Bitcoin, this can get dynamic, as we know. I mean, you just look at the range that we've had over the last 6 months. We've had $400 MSTR. So this could be a really high leveraged return into next year if Bitcoin is bullish. So if you like the Bitcoin bull play, I think there's some serious justification to this. Like, and I wouldn't go to January. I'd give it some time just because if I'm looking for that kind of magnitude thing, I don't want to bet for 100% in a month. I mean, it's not that expensive to buy a $200 call in a name like MSTR for 9.25, 9.5 range, knowing that it could be $100 option if I am willing to let it run. Now, if I am the guy that says, I don't like waiting and I'm going to sell it out when we get to 200 bucks, then that may be the wrong strike. Or I make sure I have to have a position that I can manage. So it depends upon the amount of capital I'm willing to put in here. If I'm willing to pay 9.5 today, and I only have $1,000, then I'm putting all my eggs in on one trade, and then I've got to look at selling a $300 call into a rally to 200, or just taking the profits. If I've got more capital and I'm willing to buy, say, 3 contracts or multiples of 3, I could sell 2/3 at 200 and leave a third to run. It's just managing the trade and saying, if we get to 200, I've financed the whole trade by selling out 2/3 of my position. And then I let the last third continue to go in case we run to 260, 270, or up to 300. If I'm not the kind of person that has the comfort with just letting it run and letting it ride towards 270, 300, then, that it's just may not be the right trade setup for me, right? But MSTR could be an interesting one as well. So like MSTR, Netflix, those are in that tech space. Target, PayPal could be something else if you're looking away from tech. But those would be potential interesting candidates, I suppose. For the week, weekly power trader names. So let's just start with SPY again. SPY on the week. The Monday there we go. The Monday open was 686. So we're down, call it $6 minus 2 for the dividend, so down $4, down 2/3%. Just kind of review them again. Citigroup up on the week. That's positive performance. Great. CSX week, down $1 is down, 3%. So CSX loser relative to other ideas there. GEV. For now, a loser, down 10%, so down about 3 times the standard deviation move for SPX. Not a strong performer overall. GEV had major liquidation on Wednesday that really killed it. Johnson & Johnson, down a little bit from the open on Monday. Keep in mind that the open on Monday was 210, so we're down about 1%. About in line with the S&P move. Triple M, we know it had some weakness early this week. The open on Monday was 170, so down 5%. Certainly an underperformer. That said, I did, as I mentioned, buy in with some January 165 calls on Wednesday, 3.25. This is like that range-bound trade concept. Because these were 3.25. Right now, there's no liquidity, but call them $3.50. And I'm looking for a bounce back to 170 to 173 range. I see enough return on the bounce to justify it. So versus like an NVIDIA where I was saying my max return on capital is probably 50%, my max return on capital in Triple M is over 100%. So if my thesis is that 50-50 shot that we get the bounce back, I need at least 100% return to make it worth the trade for me. And I figured, I think that this can get to maybe $8 on that call. So 3.25 up to 8, that's about 150% return, worth the risk. May not be, it's not going to happen every time, but if it's a coin flip to make 150%, I was okay with that. Not okay with it if I'm going to make a 50% return half the time and lose 100% half the time, or lose 50% half the time and make 50% half the time. Now I'm just a break-even trade. And I still like the way Triple M looks here. The model continues to be within my trade expectation here. Yesterday, as we had mentioned yesterday, it was projecting another consolidation day. Possibility of a bounce today. Maybe we settle here. If we have more bullishness today and we close, in the 164, 165 range, we may see the model project up a little bit higher. Right now, it's projecting up to 171. Earlier in the week, it was projecting up to 173. So it's shifting a little bit lower, but we'll see how today's price action plays out. NEM 100 pin today looks like the big trade idea. Still 12.15 open was right here, so we're unchanged with the market down. 100 pin looks again to be the more likely scenario. For paid, we sold that 96.95 put credit spread, just putting in a penny bid to cover it off. Not because I expect it to do anything but expire worthless, but just to make sure there's no adverse assignment risk. So something weird happens after the close or something weird happens later in the day, and it's usually worth covering these things to clean out the position rather than opening up risk of something funky happening near the close. Not filled yet for a penny, but I expect that to happen at some point today, maybe in a few hours, as long as we stay around $100 a share. All these puts are starting to come down to zero. Once the people start selling teenies, which usually happens after noon Eastern, you should see that close off. For the Elite Trading Circle, Vlad also added the 9,500 here in NEM for January. Initial price of, basis 283. Let's see where that is now. 293, so up small. We are seeing this on both weekly power trader and aggressive power trader right now. I'm not looking for this to do much more than it's done so far today. It's just because this 100 strike is big. NEM. The model projects out a close actually a little bit below 100. I would expect a close around 100 here today. Maybe a little bit of consolidation in next week. We haven't seen any trading volume on the 100 strike yet. It'll be interesting to see if somebody makes a move on those $100 calls today, closing them off and moving into, say, more January positions, or how this works. Now, if we're above 100, more likely that we see closing of this position. If we're trading 99.5, more likely that we start to see closing of this position. If we're trading 102, it may be that somebody's at that point where they just trade stock and exercise or get assigned on the call options. But within the range of maybe 60, 70 cents of $100 a share, and we may see some volume on this later in the day. That's great for the market makers. I'm not saying there's anything I would do about that. The market makers are just going to get paid a little bit once these things tighten up a little bit. There may be some big volume for them today with calendars or something like that as people rotate out of that bigger open interest that's right at the money. All right. Going through the other aggressive power trader names for today, we've got Airbnb. So Airbnb has been on a tear. It's not my style. to buy after already having a full month of rally. To each their own. If you're looking for a trade that's got some momentum and it's continuing higher, should see some support at 130. Next week's put credit spread's not going to pay me. Probably a stock trade again, because 130 looks like my support level. That's the breakout level. We're now too far above it to sell a put credit spread. The rally may slow down here. So I don't necessarily want to go call vertical either. The realized volatility on this move has been a little slower. So it looks like a stock trade with a 130 stop and maybe a 142 target. So $5 risk for $7 profit. And again, more of a stock trade. CHRW industrials starting to go up a little bit more here. This one's breaking out while triple M and the 3M in the industrials is trying to play the bounce back. This could be interesting for a outright call because the realized volatility has been a little bit higher. There's some funkiness there. What was that? That was the earnings gap. This one, I don't know why that's showing. Oh, that's just the gap back down from so there was the earnings move. October, we had the earnings move. So gap on earnings and then realized volatility comes down. And you can see realized volatility tends to be around this 23%, right where the implied volatility is. So pretty fairly mapped out. It's relatively liquid enough. Like a 170 call is pretty cheap at $2.50. $2.50, pretty limited risk. I mean, if I was going to trade stock, I'm going to be risking $4. So if I'm risking $2.50 to buy the call and look for a continued rally here, normal expected move of about 1.5% per day, $3. It seems like a decent leveraged way to play that move. Again, no weeklies, so I don't like put credit spreads because I can't get short enough term, and I don't get that much premium in the low volatility environment it's got. But CHRW could be a long outright call candidate here. All right. So, that's kind of the quick review on all this stuff here. I did want to pull back up. And here, let's go back to, that's right, it doesn't show yesterday's earnings. Well, we had FedEx earnings yesterday after the close, and a pretty minimal move net. So it started with the drop, bounced back. This was not really a great candidate, or didn't look to be a great candidate for an earnings play. Ends up now being an unchanged move. On the open, it was pretty much in line. I will note that FedEx, one of the things I like looking at FedEx for is more of another indication of where the economy stands. We do maybe see some of this FedEx rally as people are expecting a lot of online holiday shopping. Seems like maybe that was part of this play. The earnings came in well enough that it didn't negate it. Looked like it might, and then now we get the bounce back. But FedEx, UPS, when I see shipping stocks, packaging shipping stocks bullish, I think of that as a good sign for the economy. And honestly, when I see Amazon bullish, it tells me that people are spending. And Amazon's not great bullish here, but if UPS and FedEx are bullish, I would think Amazon might have a little bit more upside here, even though they do their own shipping. It tells me that people are doing some purchasing out there, and maybe people are just moving away from Amazon and trying to find the sales elsewhere, like Costco or Walmart. Looks like Walmart more than Costco. Maybe Macy's. Macy's has a lot of, was doing a lot of toy stuff. I believe they acquired Toys R Us. It was Macy's, right? Yeah, it was Macy's. So, getting some more of the toy shopping there instead of at Amazon, maybe this holiday season. So let me circle back on a couple more other recent ideas that have been coming up. Like we got Adobe on the bounce back, just to see where we're at here. I think Adobe, we're very close to that support level. So, I think, based on this idea of kind of trading some of these low return windows, buying into some of these little dips that mean nothing is not a bad strategy. Buying in here with a 349 stop. Now I've got $3 of risk for a move to the 200-day moving average 365. Risking 3 to make 13. And I can do that in a number of different ways. I could do it with stock. I could technically do it with the options, selling 347.5, 345 put credit spread, but knowing that I got to stop out before we get through my short strike. I could technically do it with a call, buying the 355. Not going to give me big return, but sort of works nonetheless, as long as it happens quickly. These are sort of the trades. I would probably rather just be a stock on a lot of these trades right now, though, because it's, when trading a tighter range, when I'm looking for a big multiple standard deviation move, I want the leverage of options. When I'm trading for just pure consolidation, I want the bigger return on the put credit spread and maybe a little bit more room on the stop. When I'm trading for a tight range, it just tends to move towards a stock trade or a stock replacement trade. So I have to find a bigger range potential, like I'm seeing, like the way I'm looking at Triple M, where the range can move us up another $10 from here. That's more meaningful. Now I can look for a call. NVIDIA, I just don't see a big enough range move to buy the call yet. IBIT, I could still buy the call because there's a view on my side of, yes, maybe we stall out at 54, but if not, then we can go to 59 or even 62. So that's like the MSTR trade, where I've got to take a little bit of profit at 54 and then let a little bit run for 60 or 62. And, that's been the kind of trade, and I still think it makes sense, is like anywhere between the 50 and 52 call for the long side, and into rallies selling 60 calls. Or buying, that's assuming I'm only buying one. If I'm buying 3 or a multiple of 3, selling 2/3 or a third, a half, 2/3 of the position at 52, or sorry, once we get to 54, and letting the rest run. So I've got that upside left, and I don't feel like I missed out on the last bit of the run. All right. But that comes back to like that trade plan. If your trade plan is to take half the profits at 54, then I either have to sell half my 52 calls out, or I've got to, at the very least, turn it into a call spread. Now, turning it into a call spread, I'm not taking half my profits. I'm probably taking closer to a third. If I want to take 2/3 of the profits, I've certainly got to sell 52 calls. If I want to take a third of my profits, I can do either one. I can sell 1 out of my 3 52 calls, or I can sell all 3 of the 60 calls and turn it into 3 call verticals. So, kind of running through how I want to manage it into a rally, and positioning based upon how I want to manage the trade as well. Because if I just buy one, I really only have 2 options: sell it all at 54 or turn it into a call spread at 54. And if that's all I want to play with is less than $200, so be it. That's a fair approach. But if I want to have more to it, structure the plan ahead of time so that I know what I'm doing when we get to 54. And I'm not stuck saying, okay, how do I want to evaluate this? What do I want to do? If I have 2 avenues when we get to 54, if and when we get to 54, of either I'm selling a third of my position or I'm turning it all into call spreads, then I'm only choosing between 2 menu items instead of saying, okay, I do want to take some profits. Now, how do I want to do it? And having to go through that whole evaluation at that point. Pre-planning is, I think, important when we're getting into slow market. That's a useful way to spend my time when I don't see a lot of new trade opportunities out there. Or pre-planning by saying I want to look for new opportunities that may arise into the new year, whether it's that Netflix or MSTR, tax loss selling now turning into bullish, or I want to look at Apple and say if this 50-day moving average holds and we start to show higher highs, I want to look to start trading this range up to 285. Or do I want to start looking at a put credit spread here in Apple if we get a little lower? Right now, 265, 262.5 is only 26 cents. But if we drop to 268, maybe I want to look at that. If we get, it's an if then, not a execute now, but start setting up that watch list again. And that's like kind of the nature of trading, is rotating between managing positions, trading actively, and then setting myself up for the next trades, because I don't have to trade every day. And if I start setting myself into a mode of saying I want to trade every day no matter what, that's how I burn capital. Because if I trade when there's no opportunity, I've either locked up capital for when there is opportunity, or I've got myself focused on a bunch of low expected value or even negative expected value trades. Anyway, let's run through some of the Warren Buffett trades. 292.5 looks like support in Alphabet. 292.5, not enough premium for the put credit spread. The post-Buffett announcement, we jumped. Buffett was announced here after the close on the 21st. So we were trading about 300. 300 could be a good bounce point. We did test it on Wednesday, so a little bit concerning. But if you want the Buffett trade, one of the more recent ones, if not the most recent one, Alphabet. Prior to that, the big one that we had been watching was UNH. He announced his position on August 15th or August 14th after the close, August 15th, one of those two. Got the bump. Made 295 our big support. We did try to test back down to it. It's starting to chop slightly higher, so range bound, chop up. Again, trading the range, either looking for a 320, 317.5 put credit spread, which again, not enough premium for next week, 31 cents, or looking for the call trade to go to 350. And for 350, if I buy the 340 call, I'm making 50% again. If it happens fast, I'm making 100 plus percent. If it happens slow, I'm making 50 to 75%. It's in that questionable range of whether it's worth it or not. Because if the ultimate upside is 342.5, I still make profit as long as it happens soon. If it takes a full month, I'm losing money. So again, for me, I don't see that quite enough to justify. I'd rather look for that put credit spread if we dip, but maybe I'm hesitant if we dip too much more anyway. So maybe just focusing on Alphabet for the Warren Buffett following trade and saying, 300 looks okay. I'm going to be a little bit stressed if I sell the 300, 297.5 put credit spread for next week, 56 cents. But at the very least, right now, we're seeing some tech money flow, and it looks okay. And if I want to be more bullish and play for 330, the January 310 call right now is $7.50, and that's a good return on capital. Frankly, I think that's probably better than the put credit spread right now. 100%, maybe as much as 200% return. So Alphabet could be an interesting one for, again, buying a call on the dip, but it's based upon the idea that we can go to the highs of the range, not just to 315. Go to 315 and I don't make much money. Put credit spread's great. If we only go to 310, 315, the call's better if I'm more bullish and looking for 330. And that comes back from that tailwind of the market. If tech is giving a tailwind, I tend to like the call side better. Maybe a little bit more back in the industrials. GE has been looking interesting over the last week or so. Big resistance at 315 though, so we may be just range bound shop here. Other industrials that may be a little bit better. Caterpillar just touched the 50-day moving average and bouncing off. Looks like 620 could be a target. Support is around 550, not enough premium to sell 550, 547.5 put credit spread certainly. But if I want to play for the bounce to 620, the 580 calls could double in that scenario. A lot of 50 to 100% kind of returns for some of these names. And those that have 50%, not as attractive. Those that have 100 plus percent, Alphabet or Triple M, those are more interesting to me. All right. All right. And we'll run through these again real quick. Under Armour, Carnival. I haven't seen that on here recently. Let's check Starbucks. JP Morgan. And then we're getting into pretty low vectors. So let's try these guys out. Under Armour, range, right? So the projections effectively for Under Armour in the next day or two, we may get to the highs of the range around, it's only 4.5. Never mind, I didn't realize Under Armour got that cheap. Pass. Carnival, there we go. That looks a little better. So we just had earnings and we jumped up. Oh, they were earnings this morning. I missed that. So they already jumped up on earnings. Man, it's looking good, but you know the projection was up to 32. Now that we've jumped, let's check RCL. How much did they jump? Looks like a gap fill potential up to 315, 320. Now that we're above or we're right at the previous earnings level. Resistance here, then 315, 320. Meh. Not that exciting. Starbucks, choppy, range trade. JP Morgan actually showing a little bit of weakness there. I don't love any of that stuff. Oops, wrong one. I wanted to go back to positions here. We have MS, JP Morgan, Cisco. MS, JP Morgan, and Cisco. Let's try MS. Yeah, I mean, bull flag bouncing off the 20-day. Back to the highs seems natural. The call vertical is okay. It's down a little bit right now because it was entered near the highs. I think we go back to the highs. JP Morgan, you know, same kind of idea, a little bit of a bull flag here. GEV was on there. You know, it's bouncing back a little bit here, but yes, Wednesday's action was a little bit dicey, of course. Now that we've bounced back, getting back above 667.5 is going to be a big level. I think around 7 to 720 would be a profit taking zone for me in GEV. Oh, and Cisco, that's the other one I didn't pull up. And Cisco, you know, where we're at, I'd say, okay, great. Can I sell a 76.75 put credit spread? You know, now, no, 5 cents. Can we go to 80? That looks reasonable. What's a January 77.5 call? It's not enough return, you know? So if I'm looking to go to 80, I pay $2. I sell it out for maybe 3, 50% return on risk or 50% return on capital. I don't see the return there. So back to that same mode of probably better to be a stock trade, which is the way the position is already. So, you know, trimming around 80, and maybe letting a little bit go to at 81. And, you know, that's kind of it, right? Basis on average around 50 cents lower than here. So generally a good cost basis. You know, probably trimming half at 80 and then the other half around 81, 82. Yeah, it's not that exciting right now. But is exciting. About unusual option volume today. No surprise. We're getting some of the marijuana companies are getting natural gas utilities. Yeah, right. Let's call it a pharmaceutical instead of a natural gas utility when it's cannabis company, right? But let's look at those real quick. Yeah, these are headlines. There's a lot of conversation about marijuana reclassification. We got a run up now. We got the announcement. Maybe these become more relevant in the future. Right now, they're a little bit volatile, but maybe these become another sector that people go back to. This, you know, a couple years ago, MJ was really, sort of an exciting investment trading opportunity. People had CGC trading $400 a share, now $1.60. These things have effectively run out to nothing. Tilray, they've had just major moves, splits and all this other reverse splits and all this other stuff to try to keep them from having to go fully bankrupt. But maybe those things have a chance to come back around and become a more interesting investment thesis for people again in the coming year or two, and they'll be volatile. And so there may be day trading opportunities there again. But right now they're all kind of just in that first stage of potential recovering stocks. All right, so long story short, I think right now, maybe the two that look most interesting just off the bounce back plays could be Triple M and Google. Alphabet, these are ranging trades. Alphabet probably now would be better than Triple M, partially because I'm starting to see that tech money flow, and I got the backstop of Warren Buffett. And then maybe looking at some of those crypto related names, and MSTR, probably not something that's going to pay me today, but if crypto starts to get bullish here, this one's got that leveraged upside potential here. So I think that's the shortened version of the three that I will be personally most keyed in on today. Let's just see if anybody happened to, I don't have my stuff up right now, so let's see. Now they haven't hit this yet. This will get hit at some point, probably relatively soon, or a couple hours. And people should start coming in and selling those. So anything else you guys are looking for today, or if not, I will let you go. Enjoy your weekends. We do not have a closing bell today. Vlad's traveling, but I will be back on for the opening bell next week. Reminder, we have opening bell only next week for the holiday week. Maybe we get something more interesting during the holiday week, but don't hold your breath. Holiday weeks do tend to be a bit slow, but the opportunities may pop up if we start to see moves like this, where we're getting a 1% move in tech and a low VIX that allows for maybe some trading of the range opportunities. So we'll keep looking for those. All right. All right, guys. Thanks again, everyone. We'll see you Monday. Enjoy your weekends.